So, imagine someone hands you the keys to a vehicle that has proven, like beyond a shadow of a doubt, that it can just outrun absolutely anything else on the track.
Right, like the ultimate mechanical advantage.
Exactly. All you have to do is sit in the driver's seat, hold the wheel steady, and you win. Yet the vast majority of people handed those exact keys don't just fail to win. They actually they pull over halfway through the race, abandon the vehicle entirely, and just walk home.
It makes absolutely no sense when you phrase it like that.
It really doesn't. But welcome to another deep dive. Today, we are looking at arguably the greatest stock picker in modern history, Peter Lynch. And we're going to try to figure out why, human psychology just consistently sabotages mathematical certainty.
Yeah, and the statistics behind that paradox are just jarring.
Mhm.
We're looking at a huge stack of sources today. Data pulled from Lynch's classic books, One Up on Wall Street and Beating the Street, plus some really deep contemporary performance analysis from platforms like Corton Asset Risk Consultants.
And we also have that fascinating recent Fidelity Investments transcript to get into later.
Oh, for sure. But the craziest part of all this data is his track record. During his 13-year tenure running the Fidelity Magellan Fund, Lynch averaged this staggering 29.2% annual return.
Which is, that's almost unfathomable over a period that long.
It is legendary. It really is. Yet, when analysts actually went back and looked at the accounts of the everyday people who were invested in that specific fund, the average investor barely cleared 7%.
Wait, 7%?
Yeah, just 7%. The fund was an absolute rocket ship, but the passengers just kept throwing themselves out the airlock, basically.
Okay, let's unpack this, because before we can solve that mystery, which is known as the Magellan paradox, right?
Right.
We have to look at the engine of the rocket ship itself. How does a single fund manager achieve nearly 30% annualized returns?
Right, the secret sauce.
Yeah, and the answer lies in a philosophy that flips traditional financial wisdom completely upside down.
Yeah.
It's this idea that you, just the everyday amateur, actually possess a massive, insurmountable advantage over Wall Street professionals.
Which sounds crazy, but you have to look at how institutional money actually operates to understand why this is true. I think people assume that because a Wall Street firm manages like $100 billion, they automatically have an edge.
Right.
But Lynch argued that managing $100 billion is actually a straitjacket. Institutional managers are bound by these strict mandates, endless compliance committees, and short-term quarterly performance reviews.
They suffer from systemic career risk, basically.
Exactly.
But Wall Street pros have teams of analysts and supercomputers. How does the amateur possibly compete with that? There's this persistent illusion that professional analysts are out there hunting for the next big disruptive company.
In reality, they are hunting for job security. I mean, if a fund manager buys a safe, boring legacy tech stock and it tanks, they just shrug and blame macroeconomic headwinds. The committee accepts that. But if they take a calculated risk on a brilliant, unknown mid-cap company and it fails, that manager is fired by Friday.
There's that old industry adage, right?
Yeah. Nobody gets fired for losing clients' money in IBM.
Yeah.
Professional investors are structurally incentivized to just follow the herd. Furthermore, massive funds literally cannot invest in small, rapidly growing companies.
Because it moves the market too much.
Right. If a $50 billion fund wants to take a meaningful position in a $200 million company, they would have to buy the entire business, which triggers just a total regulatory nightmare. So they completely ignore the small cap space.
So that leaves a massive, uncrowded playing field for the everyday investor. But if I'm listening to this, I'm probably pretty skeptical. Like, a retail investor sitting on their couch with a laptop doesn't have a Bloomberg terminal. They don't have, satellite imagery of retail parking lots. How does the amateur actually capitalize on that?
By utilizing the ultimate real-time data network, which is just everyday life. Information is democratized now. Consumers notice shifts in product quality, foot traffic, cultural relevance, all of that, months or even years before a Wall Street analyst sees it show up on a spreadsheet.
Like the famous legs pantyhose story.
Yes. Lynch always pointed to his wife, Carolyn. She came home from the supermarket one day with legs pantyhose packaged in this little plastic egg.
And that story gets cited a lot as just a cute anecdote, but the mechanics behind it are brilliant. Because at the time, high-quality hosiery was exclusively sold in department stores. It was a distribution monopoly.
Exactly.
By putting a premium product directly in the grocery store aisle, the company entirely bypassed traditional retail bottlenecks. So Carolyn didn't just find a good product, she inadvertently identified a massive disruption in a supply chain.
She saw the consumer behavior shift in real time. The grocery stores were moving massive volume, the product was highly profitable, and Wall Street analysts were totally missing it because they weren't looking in grocery store aisles.
They were looking at historical data.
Right. So Lynch did the fundamental research on the company, bought the stock, and became this monumental success for the Magellan Fund. And he actually replicated this experiment later by bringing a 7th grade class into the Fidelity executive dining room.
Wait, really? A 7th grade class?
Yeah. The students created a paper portfolio of companies they personally understood toy manufacturers, baseball card companies, soda brands. They completely ignored all the complex, obscure industrial firms.
And didn't their portfolio absolutely crush the market?
Totally. They returned nearly 70% in a period where the S&P 500 gained like only 26%.
That's wild. It just proves that local knowledge is an incredibly potent filter. It's almost like being a local music fan, right? You know which indie band is selling out dive bars months before the major record labels catch on that a new genre is trending.
That's a perfect way to look at it. But, and this is crucial, recognizing the trend is only the first step.
Right. Noticing the band is step one.
Yeah, step 2 is looking at their financials. You cannot just blindly buy a stock because the coffee tastes good or the store is crowded. Consumer enthusiasm has to be backed by financial reality. So Lynch created this strict taxonomy to ensure investors actually categorize what they are buying so their expectations match reality.
Okay, so he divided companies into 6 distinct categories, right? Slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
You got it.
But if I find a company I really love, how do I know I'm not accidentally buying a slow grower when I really want a fast grower?
Well, you have to look at the traits. So fast growers are the holy grail. These are smaller, aggressive enterprises growing at like 20 to 25% a year. This is where Lynch found his 10 baggers, which is his term for a stock that goes up 10x.
Okay, 10x is huge.
It is, but you have to look at market saturation. A regional coffee chain with 50 locations has the runway to become a fast grower. A global behemoth with 30,000 locations physically cannot double its footprint overnight.
Right, so the global behemoth falls into the stalwart category.
Exactly. You aren't buying them for explosive overnight wealth. You buy them because they are cash flow fortresses. They offer moderate growth, maybe 10 to 12%, but they provide vital recession protection.
Because when the economy contracts, people might delay buying a luxury car, but they still buy toothpaste and laundry detergent. It's kind of like hiring employees. You don't hire a steady accountant, your stalwart, and expect them to suddenly invent a brand new product overnight like a fast grower would.
That's a great analogy. You match the company to the job you need it to perform. And understanding those roles is the only way to avoid the traps hidden in the other categories, particularly the cyclicals like automakers or airlines.
Because their profits rise and fall violently with the economy. And the mechanics of how cyclicals are valued traps so many retail investors.
Oh, that's brutal.
Usually you're taught to look for a low price to earnings or PE ratio to find a bargain, right? But with cyclicals, applying that standard logic is disastrous.
It is entirely counterintuitive. If an auto manufacturer is at the peak of an economic boom, they are selling a record number of cars, so their earnings are artificially bloated. Because the earnings number is so massive, the PE ratio shrinks to single digits. It looks like an incredible bargain.
But in reality, demand is completely exhausted.
Exactly. The earnings are about to fall off a cliff.
You're basically buying a ticket to the Titanic right after it hits the iceberg just because the ticket was on sale.
Yeah, with cyclicals, a low PE ratio is often a massive red flag. You actually want to buy them when things look utterly bleak and the PE is historically high. Plus, Lynch had other red flags, like avoiding hot stocks in hot industries.
And diversification, right.
Yes. That's when a highly profitable company buys a bunch of unrelated, mediocre businesses they know nothing about.
Like a fast food chain buying an airline.
Exactly. It just destroys shareholder value.
Okay, here's where it gets really interesting. Because even if you avoid diversification and you perfectly categorize your stocks and you pick a 10-bagger, human emotion can still completely ruin your financial outcome. Which brings us back to that shocking statistic from the intro, the Magellan paradox.
Right, the 29% versus the 7%.
Yeah. How on earth does a fund return over 29% annually while the people invested in it only earn 7%?
It comes down to the behavior gap and the difference between time-weighted returns and dollar-weighted returns. The 29.2% is time-weighted. It just measures the portfolio's performance over time, assuming the money stayed put.
But investors don't stay put.
No, they don't. The 7% is the dollar-weighted return. It factors in when people actually deposited and withdrew their cash. Investors would constantly pile their cash in after the fund had a massive hot streak.
Because they read about it in a magazine and feel the fear of missing out.
Exactly. They buy right at the absolute peak. And then, when the inevitable market correction happens and the fund drops, they experience acute financial pain. Panic sets in, and they sell their shares at the bottom.
It's like jumping out of a roller coaster halfway through the ride just because it hit a dip. I mean, you guarantee you'll get hurt, and you completely miss the massive climb right after.
That's exactly what happens. They systematically lock in permanent capital loss. There's actually a fantastic anecdote in our sources about this. Warren Buffett once called Peter Lynch on the phone at his house.
Wait, Warren Buffett just cold called him?
Yeah, Lynch's daughter answered, totally unfazed, and handed the phone to her dad. Buffett just asked for 7 seconds of his time to borrow a quote from Lynch's book for his annual report.
Oh, I love this quote. It's, getting rid of your great companies and holding on to your losers is like watering the weeds and cutting the flowers.
Yes, it perfectly distills the behavioral gap. Investors sell their winning fast growers to lock in a tiny psychological victory, but they stubbornly hold on to failing companies because they refuse to admit defeat.
So if jumping off the roller coaster is what ruins your returns, the solution sounds simple, right? Don't panic. But I have to push back here. It is incredibly easy for a billionaire Wall Street legend to say, I love volatility, but what about the listener right now who is worried about their kid's college fund?
It's terrifying in the moment for sure.
Yeah, how do they not become what Lynch calls a weekend worrier? How do you actually stomach that terror?
Well, you have to change your fundamental relationship with volatility. Lynch believed that the stomach, not the brain, is the most important organ for an investor. If you look at historical data, the average stock fluctuates 50% from top to bottom every single year.
Every year.
Every year, without any fanfare. Plus, there have been 9 recessions since WWII. Volatility is a feature of the system, not a bug.
But how does the average person handle a 40% drop without panicking?
Lynch's cure for macro panic is simple. Predictions are useless. He says buy in gloom, sell in boom. You have to write down the 3 fundamental reasons you own a specific stock.
Oh, so you isolate the micro and ignore the macro.
Exactly. If the market is crashing, you look at that piece of paper. Is their debt still low? Is their proprietary tech still viable? If those 3 reasons haven't changed, a price drop is just a sale. It's not a signal to panic.
So your conviction in the fundamentals acts like a parachute. And this steadfast reliance on fundamentals is so timeless that it even applies to the most volatile asset class of the modern era, which is digital assets.
Oh, the crypto space.
Yeah, we have this fascinating recent Fidelity Investments transcript featuring Chris Kuiper, and it turns out Fidelity has actually been mining Bitcoin since 2012.
Which is wild to think about. They are deeply entrenched in the infrastructure.
But crypto feels like the ultimate hot stock in a hot industry that Lynch literally just told us to avoid. It's a completely digital token. How does a classic value investor make sense of something like that?
If we connect this to the bigger picture, Lynch applies his exact same old-school filters to crypto. He isn't speculating on the currency price. He's completely ignoring the token itself. Instead, he's researching the miners.
The actual companies running the hardware.
Right. You evaluate them exactly like a traditional commodity producer. What are the miners' power costs? What does their balance sheet look like? Do they own their facilities or lease them?
Because if Bitcoin drops from $70,000 to $15,000, you need to know if they have the staying power to survive while heavily leveraged competitors go bankrupt.
Precisely. It's about survival metrics.
It's exactly like the 1849 gold rush. Lynch isn't trying to guess where the gold is buried. He's looking for the company selling the pickaxes that has the lowest overhead and zero debt.
That's exactly what it is. And when the over-leveraged competitors fold, the survivors absorb their market share. It's the same logic he applied to turnaround stories in the airline industry decades ago. Let the cycle do the heavy lifting.
So what does this all mean? If we synthesize this entire deep dive for you, the listener, stop trying to predict the macro economy because you can't. Invest in what you truly understand from your everyday life. Categorize your investments to set realistic expectations. And above all, prepare your stomach for the inevitable drops.
And that psychological preparation leaves us with a really provocative thought. We've established that information is fully democratized today. You literally have a supercomputer in your pocket.
Right, there are no more hidden secrets on Wall Street.
Exactly. There are no ignored cigar butts anymore. Therefore, in an age where everyone has access to the exact same information, Perhaps the ultimate investing edge is no longer your ability to find data.
It's your behavior.
It is your emotional discipline. It's your ability to simply sit still, trust your fundamentals, and do absolutely nothing while the rest of the world panics.
You can have the keys to the fastest car on the track, but you only win if you refuse to jump out. Thanks for joining us on this deep dive.